With the S&P 500 still knocking on the door of new all-time highs, we're going to look through a number of charts for the index specifically to find out if that is going to occur anytime soon, or if finally the momentum is going to fade enough that we get a big decline. So let's start with the live bullish patterns. Right now, we have one of them still, the same one, the bullish flag breakout that occurred on the April 24th, 76.80. We've been talking about it ever since, going on 3 months now, so a full quarter's worth. We still haven't gotten that upside target hit, but at the same time, the S&P has remained in this range, as we know, and still very close to its highs for the most part. It still hasn't rolled over just yet. Of course, there are many iterations of how this eventually could play out. And so one of them, of course, is for yet another potential bullish pattern that we've been watching to finally get leveraged. And again, we're starting to show a variation of this as soon as the market started to roll over. In June, had that potential low here, and then just a number of potential higher lows from there. Of course, any one of these, we could draw what could be the handle of a cup and handle pattern, which of course is right here currently. Again, this is being recorded midday here on Tuesday, July 28th. And so we have a good reaction to FOMC, of course, coming out on Wednesday, and 4 of the Mag 7 stocks reporting, and dozens of others, right? All that is going to come into play. And eventually we could see a return back to this 7,600 area, as we know, which has been just impossible to get through so far. But if it does, this entire thing at that point could be 2.5, 3 months worth of price action. It could be one big bullish pattern. Again, we've been waiting, and it's very important to have patience in a market like this because we've seen a lot of head fakes in both directions. And so we should address the fact that we did have one small failed bullish pattern recently, and that was this one. Now, it wasn't tiny, right? You can tell that this potential inverse head and shoulders pattern was about 4 weeks worth in length. We did get the breakout, but of course, no follow through whatsoever. And with it just like kind of hovering near 7,400, we're not really making too much of an effort to get back above it. And now spending about 3 weeks below this zone, we can't really call this a potential anymore. So that's negated. And so again, not a huge bullish formation to see come and go, but it is a piece of information that we shouldn't discount because all on the way from the beginning, regardless of how long these were in length, we just saw the consolidation zones leverage to the upside. Those could also be called successful bullish patterns. I mean, when one starts to fail, it tells us that there is at least a character change, which of course there has been ever since the beginning of June. And so bearish patterns, we've been watching this one. This is in a 2-hour chart. So, in any day, especially now, on Wednesday when the Fed comes out, it's not going to be valid anymore. But at the same time, continuing to see this kind of in play for the last few days, it just shows us that there's just been a lack of desire to push the market that much higher. And again, we know that this is beholden to the biggest names, and those have been the ones that have been struggling the most. But because of that, we just haven't gotten a necessary amount of sponsorship from the buyers to actually negate this fully. Now, it may be very well soon. So we'll have to see, of course, over the next few days to few weeks if another bearish formation then takes shape. And so again, there are other potential patterns besides these classical versions as well. We've been watching this potential symmetrical triangle pattern. Now, because this is happening near its highs, we could call this maybe an ascending triangle, right? That continues to go higher. It's obviously bullish continuation pattern from that sense. And seeing that we've been making higher lows right on this uptrend line gives some credence to that potential. But at the same time, what's been happening? We still haven't broken the series of lower highs. So until we see strength rewarded as opposed to being sold into, we just have to respect what's going on. And again, all of this is occurring within this very large trading box. And I would say the only difference recently is that in the second half of it, most of the price action has been occurring in the upper half of the box. So that's good, of course, because it means that the pullbacks have been getting smaller And so it just tells us that maybe buyers are stepping in. Maybe they just need a little bit more information, of course, which we're getting very soon over the next few days. So if you're enjoying this content, check out our free Substack newsletter, Cap Notes. We share excerpts from our premium pieces here a few times a week. Today's piece was called S&P 500, A Different View, and we'll be talking about some of these charts today. And again, from a perspective that we don't really see a lot of, and again, very well received. Every Saturday, we're talking about our 5 best charts for the week. These are specific charts coming from each individual daily note that we put out for our premium clients every day, so we can get a sense of what it is. And it's much more than just the S&P 500, key ETFs, other asset classes, and individual chart trade ideas as well. So again, it's capnotes.substack.com. Look forward to seeing you there. And so let's talk about continuation patterns for a bit, because these tend to pop up more often than not. And you think about what that is. The market is it's in an uptrend, has a digestive phase, and eventually resolve to the upside. And going back in history, of course, with the S&P 500 and most risky asset classes mostly moving higher, most of those pauses along the way are continuation patterns. So sometimes we get kind of pulled in to thinking that that's always going to happen. And again, we can see why, right? The most recent one just looks like a cup and handle pattern, which we just talked about. But so far, we're still without a breakout. So we can't count on this to happen without actually seeing that take place. So if that's the case, then it actually could be a reversal pattern instead. But again, so many of us have a bias toward the upside, it's difficult to see that happening until it actually does. This is, of course, what it would look like if this were to roll over. And it looks very similar again to what we saw from late December through early this year, when the failed breakout attempts or marginal new highs failed to get completely leveraged and the market eventually rolled over, right? Now, to get a better view of that, all we have to do is turn the chart upside down, right? So it's inverted. And now those tops look like rounding bottoms, or whatever you want to label it. And again, I think this is much better than using an inverse ETF, because the price action can just get exaggerated both on the upside and downside. This literally just turns it upside down, so we see the price action as it should appear. And again, this looks bullish. No denying it. So did this, and we got the breakout. Now, of course, our breakout eventually failed in reverse, and the market rolled over from this sense, but this doesn't look that bearish to me, right? Which means on the reverse, right, going back to this other chart, we should respect this potential topping formation. And we could do the same thing with the S&P 500's go, no-go chart. Again, looking at this from a upside down perspective, back in December, started to see this go to no-go, 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 never rolled over, eventually broke out a bunch of goes, so whipsawed at first, and then blasting to new all-time highs before rolling over a bunch more. But guess what? As this has failed to make new lows once again, then more go signals have happened. And again, we just have to be on guard for this particular scenario taking place, where eventually momentum completely swings in the opposite direction. So if we were to look at the chart right side up, again, this is what we're talking about. Failed breakout, momentum starts to fade before the bottom fell out. Once more, momentum starting to fade, still hanging near new highs. And so again, just something to keep in the back of our minds if some of this technology weakness eventually appears in other areas, right? And we'll see it there. So we did get a sell signal that I don't think many people are talking about just yet, and that is the MACD. In particular, the weekly MACD, which we have buys and sell signals here. Here it is, as we know, the faster line crossing under the slower line while the indicator is in overbought territory or above zero, produces it. And there's been a number of them going back to the middle of 2020. We talked about this before. The ones with thick red lines indicate those sell signals that worked out very well. In other words, correctly predicted additional downside, right? And so here they are. Not surprising, they came in late 2021. And the second one here was in 2023, we'll recall. This was from August to October, about 11% sell-off. Then, of course, late 2024, eventually leading to a failed breakout, and then, of course, a tariff tantrum taking over after that. But along the way, what did we see? We see more thinner red lines that showed what? That they did not correctly indicate a market selling off at all. In fact, we saw a continuation of strong uptrends, right, in 2020 through 2021, then 2024, then, of course, in late 2025, which we started to rally a little bit more, of course, before things started to roll over, but not until 5 months later. So here we are again with another attempt to avert a sell signal. So the question is, how do we avoid a sell-off right now? Well, there's one key ingredient that has yet to break. That is strong breath. Now, this is what the daily price action looks like going back over the last month of trading. And other than this 5-day streak of bad breath just recently, it's been mostly higher, as we know. That is what's kept the market afloat as large cap tech has really gotten hit very hard, right? Basically, everything else has stepped up as we hoped it would. And again, coming back so far, doing a good job from this 5-day streak. And again, toward the end of it, it wasn't even that severe, right? We had two of those bad days we talked about recently, 29% and 33%. But after that, just barely under 50%. And now some 2, potentially 3 strong days, again, according to this in midday on Tuesday. And so what that has resulted in, of course, is the advanced decline line making new highs as the S&P has topped in June and continuing to make new highs as the RSP equal weight ETF, leveraging this very big bullish pattern, continuing higher, consolidating, now breaking out to new all-time highs again so far today, right? So this shows exactly what's been going on, especially when you have the likes of XLK technology ETF, SMH semiconductors, of course, rolling over, forming these really monster tops, trying to get leverage. We'll see if they can avoid that and form bearish traps instead. But at the same time, this has all been going on as those bigger, much more influential names have been rolling over. And so it's been the best case scenario in terms of rotation, probably one of the strongest markets for rotation in quite some time. It's been now 3 strong days of breath. Again, as of midday here on Tuesday, we could have all 3 of the major indices that we track in terms of breadth, S&P, NDX, and R2K, with positive breadth readings for 3 consecutive sessions. And believe it or not, the last time that happened was right around the lows from this year, right? 30th was the last time the market made a new low of March. 31st, of course, that was the first big day, which led to the really strong advance in April and the follow-through month in May. And so that's what this looked like, right? That was that exact time, right? As we saw the market was rolling over, right? This is what the advanced decline looked like. It bottomed, and those 3 strong days of breath is what kickstarted things. Remember, this also was a bullish pattern that got leveraged with that strong breath. And this is how it looked in contrast on the way down. Remember, strong breath to finish or to begin in 2026. When that topped, when the rest of the market stopped supporting the S&P 500, but was already struggling with, again, large cap growth starting to roll over, that is when things fell apart. Yes, it coincided with the war with Iran really kicking up, but losing all that foundation at the same time was what really drove this 2 or 3 week downside follow through. And so again, going back to right now, when that changed, that's when the market started to move higher. Again, we know it was led by the biggest names, but along the way, it's had support almost the entire time, as we can tell by this. And so we're in this consolidation mode, and we looked at the fact that these could be topping patterns. And a good way to see that is, again, looking at the charts just upside down, and when we compare how things played out to last time when the market rolled over, there's one key difference, and that is strong participation and historically strong rotation. And if we don't see a reversal of technology, that will need to continue to happen because if we lose the foundation of the non-growth sectors, that's when the market could be in trouble. So far, they have done an outstanding job to keep us within striking distance of new all-time highs. Don't forget to check out the rest of the videos on this channel. I'll talk to you again soon. Thank you.